Hi, I'm Brian Arcese, one of the multi-counselor portfolio managers on the Foord Global Equity Fund and Foord International Fund at Foord Asset Management in Singapore, with an update on third quarter performance in the Foord International Fund. The fund underperformed during what turned out to be a volatile quarter for global equity markets. Robust corporate earnings and investor optimism for synchronized global growth gave way to expectations of increasingly hawkish global central banks and the probable near-term commencement of quantitative tapering. Point-to-point developed market equities were flat during the period. Emerging market equities fell 8.1%, underperforming developed markets, largely due to the underperformance of Chinese bourses, which fell over 18%. Negative Chinese investment sentiment swelled during the quarter, initially troubled by renewed regulatory uncertainty, particularly in the country's technology and consumer-facing sectors. Investors then fretted over slowing growth, and finally to a potential credit default by China's largest property developer, Evergrande. As we've communicated before, we have been and remain quite constructive on the investment opportunities offered by our Chinese investments. During periods of increased volatility within the Chinese market, however, fund returns will most certainly be affected, as was the case this quarter. Against a flat equity market, the International Fund declined 4.7%, half of which can be attributed to the fund's holdings in China, which currently constitute 16% of the portfolio. I'd like to first walk through the meaningful contributors to fund performance during the period. Our allocation to and stock selection within the utilities and energy sectors contributed the most to fund returns during the quarter. In particular, SSE, a leading UK renewable power generator and grid operator, drove returns within the utilities sector, increasing 6.1%. Shares in SSE were boosted by speculation that activist investor Elliott Management had taken an interest in the company. Though unconfirmed and not relevant to our investment thesis, we're not surprised that investors are beginning to take interest in a firm with one of the fastest growing and undervalued renewable pipelines globally. Likewise, investments in SBM Offshore, the global market leader in the design and manufacture of offshore floating oil production storage units, which increased 18%, and Total Energies, a top European integrated energy company, led fund returns within the energy sector. And finally, the fund's hedging positions, including our short S&P 500 futures position, contributed meaningfully to fund returns. In addition to the fund's China-exposed positions, investments in the materials sector detracted from fund performance. Fund holdings FMC, a leading U.S. agricultural chemicals company, declined 15%, and Freeport-McMoRan, a global copper miner, fell 12.2%, both lagging market returns. Slowing global growth, an inevitability following the rapid rebound experienced over the past 12 months, coupled with the probable near-term commencement of quantitative tapering, have weighed on these cyclical shares. Given the fund's materials exposure has been the largest contributor to returns over the prior 12 months, Freeport-McMoRan, for example, increasing over 200%, we view the short-term volatility as a healthy correction. Returning to China, at Foord we've long believed and highlighted that the forthcoming growth of the Chinese middle-class consumer offers a compelling investment opportunity. The Chinese economy has become increasingly sophisticated and has broadened markedly over the past 15 years. Though many investors continue to view China as the world's low-cost manufacturing hub, exports as a percentage of the country's GDP have steadily declined over the previous decade and a half. Peaking in 2005 at more than 36%, this figure today stands at 18%. Over the same period, China's GDP has grown by a factor of 7 times and will near 15 trillion in 2001. These gains have not all accrued to owners of capital, exhibited by per capita wages increasing over the period by a factor of 10 times. With these gains, nearly 50% of the Chinese population would now be considered middle class, a figure on par with many developed countries, including Sweden. Despite these market gains, many investors continue to struggle to understand China's hybrid, directed/capitalistic approach to managing its economy. This misunderstanding often creates volatility in markets, leading to market dislocations, which we've been able to capitalize on. For example, today Chinese markets broadly are trading at 30% and 40% discounts to global and U.S. markets respectively, despite offering short and long-term earnings growth in line with or better than their developed market peers. As always, at Foord we remain long-term investors focused on forecasting a company's earnings many years into the future. We believe strongly that a firm's underlying earnings will ultimately determine its value. At present, we see considerable opportunity in Chinese equities and have invested a sizable portion of our fund's assets into what we believe are high-quality, consumer-focused companies that we expect to compound their earnings over the medium to long term.